to the ThinkTank. I'm Sathvik, first year medical student at Bond Uni. Today we have our guest back again. If you haven't watched the previous episode, go do that now before you watch this, or else you won't understand anything. So in this episode, we're going to have a quick chat about the ETFs that we looked at last time and how that's kind of linked to passive income. So let's get straight into it.
Yep, cool. So last time we spoke about ETFs and exchange, which are essentially exchange-traded funds, and how they're one of the best ways to invest in the share market, particularly for beginners, particularly for people who are concerned about preserving their capital and are worried about losing their capital, which is, I think, a very natural reaction to anyone who is investing in the share market, whether you're experienced, whether you're not. The main concern, the main worry is, am I going to lose my money? Which, being more of a novice investor yourself, I'm sure you can concur that that's
of course
a big concern. There's this perception that markets are volatile, they go up and down every day. That's kind of the part and parcel of what investing is. But what an exchange-traded fund allows us to do is, if you purchase a certain type of exchange-traded fund or ETF, it allows us to buy the whole share market.
Yeah.
So by buying the whole share market, we're not betting on one individual company, but we're instead saying, okay, if we look historically, we know that investing in share market or equity markets in developed countries is a great way to build wealth over the long term. So I want to get exposure to that. In the same way that if you look at the Australian property market, investing in property here, whether you own a property or you invest in it as an investment property, is also a great way of building wealth if you look back sort of 20, 40, 50 years, whatever it is.
Yeah.
So we're going to take a bet by purchasing an ETF on the entire share market as a whole. And this is touching on what we spoke about last week a little bit, but instead of trying to nut out which individual company is going to perform, we're just going to say, I'm not going to worry about that. I'm going to just take a bet on the entire share market doing well. And we can get exposure to that by purchasing a select few ETFs, which track what we call a market index, or in layman's terms, a proxy for the performance of an entire share market.
Sure.
So for Australia, the ASX, the Australian Stock Exchange, that would be the ASX 2 or 300. Mm-hmm. For the US, it might be the NASDAQ 100 or the biggest and most common one, which is the S&P 500 index.
Right.
So you can purchase ETFs which just track those indexes over time and will mimic the returns of that index down to I think it's 0.1 or 0.05 of a percentage point. So it's quite close.
Right, again, you do it, you sort of buy it using the same kind of concepts that we talked about last
Yeah,
time. Well.
using a brokerage exchange, you purchase that ETF,
Yeah.
and that allows you to then get exposure directly to the share market as well.
Right, so how is that different to crypto?
Okay, good question. So crypto is quite an interesting one, and it's quite a timely concept because the crypto market's in turmoil at the moment.
Mm-hmm.
So how it differs is it's a different asset class.
Okay.
So if I was obviously use an example, we know the difference between investing in shares versus investing in property.
Yeah,
right?
yeah.
It's a very different asset class. In the same way that cryptocurrency is a very different asset class to equities or shares.
Right, yeah.
So what I explained last week is an equity or equities is a share in a business.
Mm-hmm.
So try not to think of it like shares. Think of it as if you are an owner in a business. If you were to go buy a cafe 5 minutes down the road, you are a part owner in the business, that cafe, if you go and purchase it. That's the same thing as buying Apple stock.
Yeah.
You are a part owner in Apple as a company. Whilst cryptocurrency is kind of different in the sense of, I like to compare it to, this is probably a bit of a funny example, but
Sure.
I like to compare it to like collecting something like Pokemon cards or I don't know, watches or something valuable. It's what you're doing is you're buying a good that is not productive.
Yeah.
It has no utility or use.
Mm-hmm.
And essentially what you're doing by purchasing crypto is you're purchasing this asset that you believe will be more in demand in the future than it is today. And hence its price will go up you're speculating that its price will be higher in the future than what it is today. But in the meantime, whilst you purchase that and hold that cryptocurrency, it has no economic utility. It has no value. If you purchase an investment property and you rent it out to someone, you're going to get cash flows from that investment property. If you purchase a farm that produces, I don't know, corn, right?
Yeah.
You will be able to take that corn and sell it.
Yeah.
If you purchase Bitcoin,
yeah,
it has no economic utility. It has no return. It's not a productive asset because it doesn't actually generate anything. It's in finance terms we won't call it a productive asset because it's not. It doesn't do anything. If you purchase a share in Apple as a business, it's going to pay you out a share of their their earnings or their profits each year via a dividend.
Okay, so that was a bit of a sidetrack. So
Yep.
we planned something.
So we're going to talk a little bit about the concept of passive investing.
Yeah, we'll go
Yeah.
down to that.
Yeah, so passive investing has become really popular in recent years.
Okay.
I think as sort of more the younger generation kind of educates themselves about investing and finance and markets, and passive investing has sort of emerged as this tool to get exposure to the share market and obtain those desirable long-term returns without really taking on the risks and being exposed to the pitfalls of investing, if that makes sense.
Yeah.
So I'll give you a brief overview of what passive investing is. So passive investing involves the purchase of things like ETFs, exchange traded funds, that simply track a market index. So what we were just talking about.
Yeah.
So let's say the Australian one, you'll purchase an ETF, such as VAS, the Vanguard ASX 300 ETF, and it will track the performance of the ASX 300, which is essentially the performance of the Australian Stock Exchange as a whole. And what you're doing is, by passive investing, is you're purchasing that ETF, and within passive investing is this concept of dollar cost averaging,
Okay.
right?
Yeah.
And that boils down to a saying we have in finance of, let me just think of it, it's more about time in the market than timing the market.
Okay.
Right?
Yeah.
So that's, I guess, another worry or pitfall people have about investing. When do I buy? When's a good time to buy? I don't want to buy when things are too expensive. I don't want to buy when things are too cheap.
Yeah.
Or I want to buy when things are too cheap. I want to buy when things are really cheap, should I say. So by dollar cost averaging, what you're essentially doing is you're saying, here's my paycheck each month, whatever it is. Let's say you get paid, I don't know, 10 grand. I'm gonna set aside $2,000 a month to invest in the market index,
Okay.
our ETF that we
Yeah.
talked about, that tracks the Australian share market index. I'm gonna then go put it in at the end of each month. I'm gonna go put it in, buy how many shares I can buy with that $2,000, and then I'm gonna forget it and not open my trading account. I'm then gonna get paid the next month. Next month rolls around, I get paid. Oh, there's another $2,000 to invest. I'm gonna put it into the same ETF, and I'm gonna buy it,
Right.
no matter what it is. And I'll continue to do that consistently and systematically until the end of my investment horizon.
Right. Okay.
Right. Now, what that does, this is what it does, is the benefit to it is the fact that the markets can be incredibly volatile. It can be up here, it can be down here, it can be in the middle, right?
Mm-hmm.
By purchasing consistently, could be every week, it could be every month, whatever, but at consistent time intervals, you're buying when the market's expensive, you're buying when the market's cheap, and you're buying when the market's fairly priced or fair value.
Yeah, we're in the middle.
Or in the middle,
Yeah.
right? So you're not worrying about things being really expensive, you're not worried about things being very cheap, you're just buying no matter what. And by doing that strategy, if you actually do some Googling, don't just take my word for it, if you look up the, people have done the numbers on this strategy, it's a tried and tested way, and it actually outperforms considerably people who try to time the market and predict the market and try and buy when it's expensive, cheap, or whatever, because fundamentally no one knows what the market's going to do.
Right.
Past performance is not a predictor of future, a reliable indicator of future performance, and when you're investing there can be a lot of biases, heuristics and emotion that comes in that can influence your decision making and what you do. So by just dollar cost averaging purchasing the market index and reliably investing at the same time interval over a very extended period of time, you can remove that influence of emotion that influences it, and you can just get exposure to the share market over a long period of time to your benefit. So,
right, so you kind of invest sort of consistently in time frames, and it will become a habit.
Exactly.
And you don't really kind of think about what the outcome is going to be, you just got to do it. And then you know that however long you've been doing it, the market's going to go progressively higher. So whenever you do, yeah, all for good intentions.
But typically yes, because inflation rises. So typically you would see, as inflation rises, you would see a business's earnings continue to go higher over the long run, which will push share prices higher. So yes, that's.
So if we're looking, say, maybe 40-year sort of investment portfolio time span, from the time that you start to the time that you kind of finish, you will definitely have it higher, or a high chance of you having it much higher.
Yeah. There's a high likelihood.
Yeah, and rather than just sort of trying to gamble with the market, trying to see if it's if it's going down, if it's going up, or whatever.
Because history tells us, and it's no fault of our own. It's a predisposition we all have because of our emotions and biases that we all have. It's just that's what makes us us. But typically, people invest at all the wrong times. There's this old saying that when the taxi driver or the grocery store worker tells you, "Oh, I'm making a huge amount of money on the share market," that's when you got to get out. But that's the case, because what happens is when there's a huge boom on the share market, that's when people start telling everyone, "Oh, I'm making all this money," and that creates more hype and more people get in. And there's FOMO. And that's when you start to get what we call a bubble, right?
Yeah.
So by forgetting all that and forgetting all that emotion, that's what happened last year. By forgetting all of that and just doing the same thing you always do, investing when the market is doing whatever, you are not worrying about any of those events. You're not worrying about any sort of you always read headlines, "Oh, this is going to be the end, the market's going to crash, blah, blah, blah." Or someone's come out and said the market's going to fall and they're like this amazing investor that everyone knows. Forget all that.
Right.
Just invest no matter what, and the most likely outcome is that over the long run, if your investment horizon is long, the market will trend upwards to your benefit. And an important part of that as well is understanding the investment horizon for equities. So I think some people have this misconception that you need to buy and sell.
Yeah, I do too. Yeah.
Okay. Yeah. So tell me about that.
I've always seen over social media and through just general news outlets and stuff, you have to buy it on the low and then sell it on the high.
Buy it on the low, sell it on the high.
You hear it so often. You're just like, okay, what is this? Is that what you have to do? And that's kind of one of the reasons why I've decided not to invest so far.
Exactly.
It's because because I'm a uni student, I don't have time to just guess the market.
Right.
And I don't want to buy on the low. I don't even know what the low is.
True.
So that's kind of my experience on that.
Yeah. So that's also, I guess, a fundamental problem, and we could unpack the whole social media and influencers and the stuff they're saying in a whole other video.
Of course, that's a big topic.
That is a huge topic, and our regulator is actually cracking down on it at the moment, ASIC. But yeah, equities. What we typically say is you should have at least a 5-year investment horizon when purchasing stocks.
Okay.
Which would come as news to people. But think about this, right? I like to always go back to property because that's what everyone's obsessed with, and everyone talks about property. You don't buy a house and then flip it 1 month later.
Of course not.
And everyone thinks, oh, properties, stocks are so much more volatile compared to property. They're not. Property's also volatile. The only difference is stocks have what we call liquidity, right?
Yeah.
You're able to trade those stocks. And just because you're able to trade those stocks doesn't mean you should. right?
Right.
So what we typically say is you want to buy a stock that or buy an ETF at least. We're not going to get into individual stocks, but buy an ETF and at least hold that ETF for 5 years.
Right.
So, and in that time period, if it drops or you experience market losses, don't worry about it. Don't look at it. It's not relevant.
So it's like a set and forget thing.
Exactly.
Yeah.
What you should be looking at is your investment horizon, your end point, whether it be 10, 15, 20 years, however long, and understanding and looking at essentially wanting to look at your portfolio returns at that end point. That should be the most relevant part. For some it's 5 years, for some it's 10, for me it's like 30, 40 years.
Yeah. So it varies.
It varies. And that's where it depends on your own goals. So for some people, their investment horizon may be 10 years because that's when they envisage putting a down payment on a property, and they're going to use their share market, their money invested in the share market to purchase property. That's their financial goal. For others, it may be to accumulate $1 million in the share market and then be able to live off that live off the dividend payments and income that produces. It really depends on the individual. But I think the key point in your investment journey should be defining what your investment horizon is and defining what your investment objective is. And from that point, that allows you to have a plan, if it makes sense, to know what you're doing, and it will also put you at ease in a way, because studies show, if you actually look at the data, that the longer you're in the market, the lower your risk is of losing your capital. Okay. So if you're in the market for a week, you've got a high chance of losing your money. If you're in the market for a day, let's say I remember seeing a chart on this. If you're on the market for a day, you've got roughly a coin flips chance, so 50% chance of losing money.
Right.
But as that investment horizon extends, your likelihood of your capital, losing invested money, declines considerably.
Okay.
Once you go into the years, your likelihood of losing money is substantially lower.
Right.
Based on past performance. Obviously that could change, but yeah, it does decline as you're the longer you are in the market.
Sure. So the investment horizon is like a framework, kind of a direction, a path that you're on, and the journey that you're going to have to follow.
Exactly.
So it gives you a sense of purpose, and you're just not like playing with the game.
Exactly.
Cool. I think we've covered quite a lot in today's session. I think we'll wrap that up.
Yeah.
I don't want to get too heavy on the viewers just yet.
In the next session, we'll discuss compound interest.
Yeah.
Which will be quite a nice one, quite a spicy one.
And obviously it flows on from the sort of the time period that we've been talking about. So that's a wrap, guys. Hope you liked the video, the podcast, wherever you're watching this or listening to. We'll see you guys in the next one, so we'll catch them later. Bye.
See you later, guys.